Colleagues, I suggest that we start this session of our discussion club. I don't like the word panel for some reason. There is no round table. Moreover, that the subject that we are going to be discussing is not simply debatable, it's very debatable. And there are no final answers yet to the questions we are going to ask. And moreover, a lot of regulators did not yet start to seriously discuss it. They are rather discussing whether they should start the discussion or not, officially and publicly. I will remind you of this difficult subject. Maybe from the standpoint of humor, it cannot compete with what was discussed at the previous panel. That was the most joyful panel throughout the times of the International Financial Congress, because we are going to talk about regulation. And this is a matter that doesn't lend itself easily to humor. It's all about the difficult rules that we have to follow. So the subject that we're going to discuss is as follows. Should we see the financial regulation exclusively as an element of control and limitation of risks in the financial system, or we can use regulation as a tool that can facilitate economic growth and development? That is a very debatable question, and I'm glad that recognized persons, experts in the area of banking regulation are participating in this discussion. That is Mr. Nava, Director of Financial System Surveillance and Crisis Management, European Commission. That is Olya Ranguelova, who is the head of the International Affairs Department, ECPR. This is the French Prudential Supervisory Authority that works at the Bank of France. Before that, Olga worked at the European Central Bank and was in charge of using international norms of banking regulations in certain countries. Also, we have Kathleen Krause, a representative of the Central Bank of Brazil. We specially invited a representative of the regulator from a country that have a developing economy. It's very interesting for us to compare our experience with Brazilian experience, and probably you know quite a lot of Russian participants. Alexey Lobanov recently was appointed the director of banking regulation at the Central Bank of Russia, and before that he was a deputy director when I was the director of the banking regulation. That is a person who actually defines to a great extent, well, on the whole he defines the regulations that the bankers present in this room have to follow. Alina Vetrova, probably you also know her from our heated discussions at the Association of Regional Banks of Russia. She is the vice president. And Sergei Solonin, who represents a new association that we also start to interact with, and that is FinTech Association. So based on the composition of the speakers, you can understand how the discussion will be structured. To begin with, I will ask our foreign colleagues to speak about their experience and about their position in this issue, and then we will transfer to the Russian territory, which is certainly closer to our hearts, and we'll finish with issues that are being discussed practically everywhere, and those are the prospects related to fintech development. In order to start the discussion, I will propose a few ideas and will describe my vision of the history of financial regulation. Initially, financial regulation and banking regulation, first and foremost, was set up in order to limit risks. Because banks are not quite ordinary companies. Banks are the companies whose objective is not only to earn profit, but whose historically their prime task was not to lose the money of, and that defined the whole logic of banking regulation. After banking regulation was developed in fine detail, in the reserves of capital, liquidity, and sufficiency of capital, a question was raised how banking regulation impacts the economic cycle, how it impacts economic growth. And the next element for the discussion sprang up, how banking regulation is pro-cyclic or counter-cyclic. Well, the conclusion is that it should be counter-cyclic, and people came to the necessity of making banking regulation stricter during the period of growth so that we avoid bubbles, and should be made more lenient if the economy is on decline. Initially, that was a very simple idea of turning the nuts tighter or loosening them at a certain period of time. And then the idea of macro-prudential regulation was brought up, and at the next stage, each regulator started to use the idea of macro-prudential regulation as they deemed necessary. So we can see different elements of that in different countries, apart from one element that is common, and that is the counter-cyclic buffer that you know. The regulators went much further. A lot of them started to use higher risk ratios to certain types of assets, or lower risk ratios to other types of assets. Maybe Mario will speak about the European experience, because the issue of issuing loan to SMEs is related to lower risk ratios applied to these companies. Well, the consumer credit is associated with a different level of risk, and so on and so forth. So the regulators made attempts to customize and to adjust the financial regulation to their specific features, not to the overall phase of an economic cycle, but to the specific features of their economy. Those attempts are made, but so far there are no common approaches, no common standards. And there is a discussion about what can happen, and maybe these approaches should be generalized to select the best practices and propagate them further, because there are no common understanding of the issues of proportionality, because proportionality is also a new concept that is differently used in different countries. And although the idea of proportionality of regulation also includes the idea of supporting competition at different levels of banking system. So I suggest that we start our conversation with this. I would like to pass the floor to Mario in order to answer a simple question. Should financial regulation limit the risks, or should it support the development of economy? Mario.
Good afternoon, everybody, and thank you very much for the invitation. It's a great pleasure to be back here in St. Petersburg after last year. I believe, Vasily, the question you pose is well posed, but the reply is not simple. That means the reply...
It's a provocative question.
It's a provocative question, good. The reply is not simple in the sense that the reply is not just yes or no, or is not just a question of turning the screws, and by turning the screws stronger than you make, you limit more risk, and therefore for whatever magic you dampen growth, and vice versa. We have learned a lot in Europe about financial regulation in the last few years. I mean, I think we have been the area of the world that has made more regulation. One could claim that, of course, when the crisis struck, we were probably the area of the world that needed most. We had the lowest capitalization, in particular when you compare, for example, with the United States. But then we have done a lot, and we have improved. What we have observed, let's say, you could claim, you'd be excused to claim that our regulation overall in the last few years has been a regulation rather restricting. So it's been rather a regulation increasing the level of capital requirements, increasing the amount of liquid assets that banks need to have, increasing in general the amount of risk weights, with some exceptions. You mentioned the loans to SMEs, an exception that now has been generalized worldwide through the Basel Committee proposal. But overall, I think you would be excused to think that what we have done was essentially making the regulation stronger. And yet, it has paid a lot. Because when you look at the dynamics of growth of Europe of the last 5 years, the dynamics of Europe has improved. Europe is at the 5th consecutive year of growth. This year, for the 2nd year in a row, all the countries have grown. The macro numbers are pretty good. The micro numbers are immensely good, because the bank capitalization it's now on a par with any other part of the world. And in a way, if you want, the strengthening of the regulation has basically eliminated the systemic risk that there was perceived to be, and it has transformed what it was a systemic risk into some idiosyncratic risk. Because now what you observe in Europe is that essentially what we do is that we cure idiosyncratic risks that appear here and there in the system. The bank that we closed today, the bank that we closed yesterday, the bank that we made sure was bought 3 weeks ago. So clearly, if you want, by reinforcing regulation, we fostered competition, a bit like you were hinting, and in so doing, we have changed the nature of risk. In the moment you change the nature of risk from a systemic risk to an idiosyncratic risk, you probably do the best contribution you could do to growth. And that's why I think your question is very well posed, but the reply is not simply if you are a softie, then you favor growth, and if you are a tough cookie, you disfavor growth. That would be a too short-term reply. I think the good reply to your question is a reply in the long term, and that's where you have to look, because essentially, once again, the crisis came from an attempt to have excessive short-termism, and therefore excessive short-term return. So I think this trade-off that we managed to uncover, and this fact that we changed the nature of risk, was the greatest possible contribution of growth. And now look at what we are dealing with in these days. In these days, if you look last couple of months in Europe, what we have done was essentially to cater for difficult situations. I mean, 2 banks were closed, eliminated, evacuated, and without any risk for financial stability. Not a single depositor lost access, let alone losing money, which is inconceivable, but not even lost access to her or his money. He or she could go to the bancomat at 3 o'clock at night and take the money out. And so we did that with no problem. We had a case of a precautionary cap. We had a case of a bank selling. You could say all these are tough intervention, but actually they are probably among the most growth-enhancing intervention that one can imagine. So I believe that it is possible, when the regulation is well conceived, it is possible to make sure that at the same time it limits risk, but also it enhances growth. The difficulty with that is what? The difficulty, I think, if I could give, let's say, a piece of advice to fellow regulators from our experience, from our 5-year experience, my piece of advice would be never confuse your long-term ambitions or the steady state, so to speak. Never confuse the steady state where you want to go with where you are, and in particular with the transition where you are. And we have seen this is particularly difficult. It was particularly difficult at the very beginning of the banking union. Taking care at the same time of the transition and the steady state is not easy, because the steady state by definition is more stable than the transition. That is one thing. And the other thing, the other point I would mention for the fellow regulators is never be satisfied with let's say a low-hanging fruit or a short-term result. Unfortunately, in financial regulation, short-term results tend to evacuate and to evaporate rather rapidly, and they do not constitute a sustainable basis for the future. And if I can conclude on that, there is one thing that we really learned, which is that the financial markets, for all their behavior, they have one characteristic which is extremely important, which is that they anticipate the future. That's what financial markets do. They anticipate what comes, and they anticipate the future. So, for example, when we translate into the European legislation the Basel rules, some of them, like the leverage ratio, started, in theory, they start to be implementable from 2019. And yet, the markets anticipated them, and they made them working before. One thing I always joke is the leverage ratio, which is low in Europe from 2019. Every bank must be above 3% leverage ratio. There's not a single bank today below the 3% leverage ratio. Everybody is above because of this ability of financial market to anticipate. If you know that by 2019 you must be above 3%, you better be above 3% today. And I think we regulators would be wrong not to profit of this. And if we do that, I think that's the best way to foster growth. Thank you.
Thank you, Mario. For myself, I would like to underline 2 important lessons learned from your contribution. And those are namely, first, there is no regulation that limits risks only or stimulates only. Good regulation embraces both of them, and it is tailor-made for the economy, and by doing that it stimulates the necessary sectors of economy and destimulates those that should not be stimulated using financial leverage. But then the second question arises that relates to the European Union countries predominantly, and that's the question, or rather a challenge, that is called one size fits all. Is it possible to find a single solutions for a large number of countries, above all for the European countries, but also for all countries of the Basel community. So a solution that would fit the structure of the economy, the current needs and challenges of that economy. Because one should be stimulated, or there is a need to stimulate SMEs. In another, there is the need to accumulate public debt because the mortgage market is well developed there. In another country, the market is underdeveloped. That's just a very simple example of what I'm saying. So again, the question is if it's possible using internationally applied standards, find a right solution for every single country. It's a tricky question because indeed there is an opportunity for national discretion, which is essentially the possibility for a national regulator not to go below a stipulated limit or level, but it may also be applied to other domains. It's the matter of personal choice, so this national discretion principle is quite flexible. But the question is, how can we find a level of regulation that fits best for each economy? It's a tricky question, but I think that Olya Ranguelova, who extended over European regulation to applied it to French system, can share her vision and experience with us. Olga, please.
Thank you very much, Vasily, for having invited me once again to this Congress. It's really an honor for me, and also very interesting to have different views on this challenging topic, actually. So I tried to address the question that you ask through different, in my view, complementary angles. First of all, I think it's important to recall that during the financial crisis, we saw actually an evolution of the structure of the financial systems, namely a growing importance of market financing at the expense of banking intermediation. And this led to a series of policy responses, notably from the public authority in Europe, which objective was actually to promote growth. But it was not necessarily from a regulatory point of view. The second approach, and actually I think acts of answer in order to answer this topic, is to take into account the establishment of in Europe of the banking union, and the fact that it imposes to have an implementation, a consistent implementation of the regulatory standards. And economic development is not per se an objective, it's more an underlying rationale behind the regulation that is being developed and which is already enforced, actually. Last but not least, the financial crisis that we went through triggered some financial innovation with the emergence of digital finance, fintechs, and this actually poses a challenge to the regulator, who should take into account, in our view, both the benefits that such innovation brings to the economy and the consumers, but also actually the risks that such innovation can pose to, from a financial stability perspective. So first of all, as I just pointed out, in my view, it's important to recall that from 2007 until 2013, EU economies were affected by a number of shocks, which increased their internal and external imbalances. We had also the impact of the subprime crisis from the US, and eventually the European sovereign debt crisis, which triggered substantial difficulties in Europe. This complicated environment brought a series of factors which actually triggered changes in corporate financing. There was a context of protracted period of low interest rates and low volatility environment, and in such a context actually banks started to change their strategies, their business models. They increased their search for yield. In the meantime, we had to implement the Basel III framework, which also had an impact on the reallocation of the banking activities. Also, due to this very difficult environment, banks actually refinancing costs also increased. So from a corporate perspective, there was an increasing need to rely on a mix of a market-based financing as well as a banking-based financing. So here you have a graph which shows actually the evolution of the financial model, and especially, in the most important jurisdictions, you can see that the importance of market financing increased during this period. Although in Europe, banking intermediation remains still preeminent. Amid this complex economic context, corporate financing has been a major area of concern for many European member states. In France, for instance, public authorities have shown their commitment to reducing, to limiting credit crunch during this very difficult period in order to also limit the decline in economic growth. They also search to enable corporates to access to new financing sources, and notably the small and medium-sized enterprises, which were supposed to be the most affected. And of course, this they had also to take into account financial stability. Here you have some examples actually of the different initiatives that were supported by the French authorities in order to limit the credit crunch, which could potentially affect credit loans to corporate, and also economic growth. In France, for instance, there was the establishment of a public bank. It's called BP France, Banque Publique d'Investissement. It was established in 2012. And its main objective was actually to address the market failure that you can have, namely to address the issue of financing innovation. So this bank can co-finance different projects. It is also guaranteed by the state, and there are some partnerships also with other credit institutions. Another initiative which objective was also to help the small and medium-sized enterprises was the creation of médiation du crédit. I don't know how to translate it, maybe credit mediation. The objective here was to reduce, for instance, the delays in payment for the SMEs, so that they remain resilient, and so that they could face actually this difficult economic period. The other reforms also aimed at increasing the diversification of the financing sources, notably in terms of debt for small and medium-sized enterprises, and also a recourse to equity financing. aside from these initiatives which were brought by the public authorities and which are not necessarily related to financial regulation, but they are, in my view, very relevant if, given their positive impact in terms of maintaining corporates lending during this difficult period, namely the financial crisis. The establishment in Europe of the banking union aims mostly at ensuring a resilient banking system. And in this respect, there is very little leeway in actually having some flexibility in the way regulation is being applied, so as, for instance, to foster economic growth. Although it's a kind of hidden objective. For instance, in the area of supervision, the European Central Bank is very sensitive to ensure that all the important banks in Europe, there are 130 that fall under the ECB direct supervision, are subject to the same rules and methodology, and that level playing field is ensured. However, these objectives notwithstanding, it's maybe interesting for you to highlight that the ECB also conducts regular impact assessments of its individual capital decisions. Actually, on a yearly basis, so the European Central Bank assesses whether its Pillar 2 capital requirements, which come in addition to the Pillar 1s, would trigger some decline in corporate lending. So the methodology which is used here is a combination of quantitative approach, which objective is really to assess whether there would be a deleveraging in terms of credit growth. And you have also a bank-specific supervisory knowledge which is added to this methodology. The objective is to assess whether the strategy of the bank would be to increase its own fund and how it will reallocate its portfolio should it face an increase in capital requirements. So these impact assessments are carried out on a yearly basis, and they really, their objective is really to assess the impact from a short-term perspective of the implementation of the supervisory measures. From a broader point of view, empirical literature also elaborates on the costs and benefits of higher capital requirements. And for instance, for banks, it is usually mentioned that higher capital requirements can translate in lower, lending for households and corporates. Meanwhile, in terms of benefits, of course, you have the idea that banks are better capitalized and they also benefit from a lower cost of funding, including if they want to finance themselves on the market. And of course, better capitalized bank can provide more stable lending, especially in times of crisis, and the systemic risk is reduced on the longer term. So at the current juncture, we can say that the European banks have to face a capital demand in terms of core equity tier 1, which is around 10%, so for the most important banks, and their actual CET1 ratio is around 30%. And if you go, for instance, to all the literature on the impact assessment of higher capital requirements, for instance, the Basel Committee regularly publish such studies, you can see that these levels are above to those which are considered as optimal from the point of view of cost-benefit analysis. Another topic which is still a little bit tricky, and it's a kind of legacy of the financial crisis, is the issue of non-performing loans in Europe. Some countries still face very high non-performing loans ratios in their balance sheet. You can see notably the first two countries, and this can actually hamper their capacity to lend to the real economy. So these very high level, I mean, in certain countries and in certain banks, is a very challenging issue for both supervisors and regulators. And there are many works underway which aim to restore the intermediation capacity of the most vulnerable banks in the countries that you saw. So as a first step, you had, like prior to the establishment of the single supervisory mechanism, an assessment of the quality of the balance sheet of the banks, and this was conducted in 2014. This year, the European Central Bank released a guidance on non-performing loans with the objective to help banks to handle this topic. There are recommendations in terms of strategy, governance. For instance, banks are incentivized really to handle this topic through dedicated teams. We have recommendations in terms of provisioning, notably from a qualitative point of view, and disclosure incentives. And also beyond this response, several EU fora and institutions, including the Commission, but also the European Systemic Risk Board, are currently reflecting on other policy responses, such as the development of secondary markets, the setting up of asset management vehicles, which would manage the NPLs that would be ceded under certain conditions by bank, and also what could be seen as best practices in the area of securitization. Last but not least, actually all these, the financial crisis that we went through also triggered a new wave of financial innovation, notably in the area of digital finance. And this new wave of innovation brings many benefits to the consumers, given that these actors actually provide a wide array of services and products. They also decrease the prices that are being paid by the consumers. And in some cases, they contribute to improving the compliance with the regulatory requirements. And from the broader point of view, of the economic point of view, they facilitate in some cases the financing of the economy, for instance through crowdfunding. There are also in the meantime risks, of course, because these new players are increasing, are competing with the traditional banking organization. They also increase operational risks. You have the cybersecurity issue, cloud computing. And in this respect, regulators pay greater attention also to anti-money laundering and the finance also of terrorism. It also poses challenges for the supervision and regulation of these market players, which are very diverse and which activities are constantly evolving. So from the point of view of the regulator, you have actually to reconcile two key dimensions. Firstly, innovation, which can bring many risks. I just elaborated on that. I can also quote the crisis that we had, like on the subprime, the subprime crisis with the development of new techniques in terms of securitization. You have also the increase of the high-frequency trading players, which can disrupt the liquidity on the market. So innovation brings benefits, but also risks, and that's why financial stability has to be taken into account. So from the point of view of the French central bank and supervisors, the key principles of digital financial regulation are the following two main areas that are presented here. First, the idea is to ensure an absolute guarantee of payment and transaction security. This refers, for instance, to crowdfunding, to the fact that now there are many online solutions, without any cash payments. And the second area is to adopt a proportionate regulation and supervision to address the development of fintechs insofar as they cannot be supervised in the same way as the traditional players are. And for instance, in the case of France, we have set a dedicated unit at the ACPR, which is the supervisory authority, and also with the securities supervisor, Autorité des marchés financiers, so that they can coordinate themselves while they grant a license to these players, or the way these players should be supervised. The ideal is to impose actually the same type of rules to the same type of activities. And also another dimension is that regulators should really coordinate themselves, given that these entities are operating on internet maybe and across the borders. So from my experience from the single supervisory mechanism, we saw that it's really important to keep pace with emerging activities from a single player but across different countries, so that to ensure that consumers are well protected while having this cross-border consolidated point of view. So, thank you.
Thank you very much, Olga. I liked very much about the NPL. You showed the countries with. You showed the good countries with good credit portfolios. Please don't take picture of me with my hand like that, because it's always in the media. It's a joke. Yes. So the NPL level is 3 to 5%, and those are the countries with a good credit portfolio quality. And the second category of countries with a bad portfolio, where the NPL level is 15 to 42. And it's pleasant to know that if we are not in the first category, we're very close to that. For corporate borrowers, I can't remember the latest numbers, but I think the NPL was something like 6%, 7, okay. Yeah, I think it's 7 in corporates. For physical persons, it's a bit higher, probably 8%. So we are between the first and the second category, but we're closer to the first one, and that's good. From the standpoint of this discussion, I learned 2 interesting and important ideas. As a result of the survey, empirical survey supports the idea that increasing the capital requirements in the long term facilitates economic growth. It's very important because the regulators usually criticize this idea. So they believe that if you enhance those requirements, the credit leverage is smaller, but because banks are better capitalized, are more stable, the credit level of the economy increases and the growth of economy is greater with a highly capitalized banking system. And the second important idea is that in these conditions, when the rules of financial regulation are the same and the national discretion is limited, national regulators try to facilitate the economic growth in these sectors and in those segments of economy where that is necessary with non-prudential methods. They start to set up even infrastructure of a financial market at the regulator in order to stimulate loans to SMEs, like it was said here, or government tools are set up, or institutions at the financial regulation bodies, such as an equivalent to a national investment bank that would invest into innovative projects when the market is not ready to invest into them. So there are different tools, non-traditional tools for stimulating economic growth, and that's also very important to understand. Now let's go to the other side of the planet, to the other hemisphere, to the Western Hemisphere, and to the Southern Hemisphere. I would like Kathleen to talk about how the Central Bank of Brazil provides financial regulations given the specific features and priorities of the national economy.
Thank you, Vasily. Thank you very much for inviting Central Bank of Brazil to speak here today. It's a great honor for us to speak in this very important and successful event. So the topic of this panel or this roundtable is at the same time very opportune and very challenging. And I will try to add some contribution to this discussion, briefly talking about some prudential regulation and economic development, this trade-offs and its conflicts. Actually, as we have realized this morning in the plenary, it was enhanced that the first is a conditional for the second. And I believe that a key way to assure this better relation between them is try to settle right balance between stability and efficiency of the financial system. And finally, I would like to talk about some Brazilian initiatives in this context. So first, this trade-off. From one side, we have this economic development, and we are talking here about the raising productive capacity, full employment, growing GDP, improvement of quality of life, etc. But these demand resources, this demand financing, investments. And where does resource come from? Mainly from the financial system. And this economic development requires an environment which must be very stable, so it requires a stable financial system, which is sustained by sound financial system. And how to ensure a sound financial system? Mainly by prudential regulation. So it's indeed the main goal of the prudential regulation to mitigate risks. And in this sense, what the bank's regulator do? What we do. We require banks to have strong frameworks to measure and control risks, including robust technological systems, including very sophisticated approaches, including also qualified personnel, free independent risk committees and managers. And at this point we can recognize there is at least one immediate incentivization for the employment growth. We also require banks to have minimal liquidity buffers, maximum leverage ratios, and so on. This kind of requirement actually does raise some restriction to the credit offers. and this could be detrimental to the economic development. But we should extend our analysis from the short-run effects to the long-run effects, and recognize that prudential regulation has an important role to ensure a more stable environment in which the agents can assess the risk and return information associated with these investment decisions. We can take a look, for instance, to a list of some empirical studies that already evidences the net benefits of prudential regulation on economic growth. We're not going to into the details of each studies here because it's easy to find the details in the internet. But all of them have some common conclusions, some common findings, like stronger capital and liquidity standards have a modest impact on aggregate output costs. And they also find that the requirements could reduce credit supply as well as decrease credit demand in raising lending rates, which may slow down economic growth. However, having better capitalized banks enhances financial stability by reducing banks' risk-taking incentives and increasing banking buffers against losses. The authors, most of the authors also find out that in a regulated economy, there is less but more productive lending. They remark that a resilient economy absorbs exogenous shocks and recovers quickly. So most of the authors found out that the net benefits of the prudential regulation substantially exceed the potential output costs. I believe that the message given by Sabine Lautenschläger in March 2015 is a good summary of this reflection. She gave us an important message regarding regulation and supervisory. Supervisors can contribute to sustainable growth by ensuring that supervised entities are resilient to plausible shocks, properly managed, adequately capitalized, and subject to an efficient risk management and the risk incentives. Oops. Something happened with this slide. Okay. Oh, this is because the Brazilian slide, so everybody was scared about the Brazilian numbers, maybe. Moving to Brazilian world. First, let's figure out a stress scenario. Imagine that. GDP moved back more than 7%. Unemployment reached 14%. Inflation reached also double digits. Large companies involved in corruption scandals, politicians as well. Fiscal primary surplus of the public sector converted into a primary deficit. Add impeachment of the president. So how do you think about this scenario? Is it too exaggerated to be believable? Well, this is the main difference between scenarios and reality. Scenarios must be believable, reality not necessarily. So this is exactly what Brazil has faced in the last 3 years. Brazil went through the most severe economic crisis in the Brazilian history. In spite of the severity of this multifaceted crisis, which encompasses fiscal, economical, political aspects, the Brazilian financial system remains resilient. It not only absorbed it, but it did not propagate it further. Despite the fall of profitability, the return on equity remains above the risk-free rate, and it's not a low one. Other financial soundness indicators prove that the system remains sound, well capitalized, and liquid, although the levels of loan loss provision has risen. Capital levels and leverage ratios are well above the minimum requirements, regulatory requirements. Liquidity is not a source of concern, neither in a short nor in a long-term basis. And the stress tests demonstrate that the Brazilian financial system is capable of absorbing more severe shocks. So far, we can say that prudential regulation has been working. However, the Central Bank of Brazil has concerns not only regarding the shorter run effects, such as volatility in prices, credit, and so on, but also regarding the long run effects of regulation. I mean, stability, crisis prevention, loss absorbing capacity. From a more holistic view, when thinking about economic growth, we can say that it's important to ensure not only financial stability, but also the efficiency of the system as well. In this regard, it's important to implement in a consistent way the standards requirements settled by the international organisms like IOSCO, FSB, Basel Committee, and so on. Nevertheless, it's also important to take into consideration the Brazilian market features and its needs in order to promote a sustainable growth. We understand that there is absolutely no way a one-size-fits-all approach can do justice to today's banking landscape. With this very large and complex institution, its numerous smaller and regional institutions, and the wide expanded of medium-sized institutions. One-size-fits-all or a unitary regulation could result in an overburden for a smaller institution. That is, a fixed cost that well in excess of what is needed to ensure that these usually simpler institutions are safe. This overburden can unfairly strain the competitive ability of the affected intermediaries, creating the too small to succeed. In this context, we have been reconsidering the scope of implementation of Basel requirements, especially the Basel III reforms, as this kind of requirements become too much complex. And in our regulatory framework, we recently introduced a categorization of financial institutions for the future application of a more proportional prudential regulation. So proportionality is another word we have been listening a lot in this panel this morning, in the plenary this morning. This framework will balance the regulatory demands on each institution, depending on its category, which takes its size and complexity into consideration. Another aspect will be the rationalization of both compliance costs for financial institutions and supervisory costs for national authorities. Therefore, with this regulation, we envisage a set of structural benefits from the establishment of segmentation rules. First, the competitiveness of smaller and simpler financial institutions is enhanced without compromising their individual soundness by reducing their excessive regulatory burden. In addition, the financial system has a higher contestability by providing challenger institutions with more more simple in regulatory environments according to transparent criteria. And finally, this new framework enables Brazil to continue being compliant with international standards once this kind of requirements will still be implemented by the largest and active, international active Brazilian banks. Overall, it should ultimately result in a more efficient financial system. So, thank you.
Я уверен, что аплодисменты это.
I'm hopeful that all bankers are applauding to you because they believe that the proportional regulation will contribute to the development of your banking system and national economy. Because as far as we all remember, there were really big debates on that issue, but we're not the only one following this approach, and I really like that your country succeeded in proving that, and finally many regulations apply to proportional regulation, and we are not the only one who think that it's appropriate. So I think now the time has come to give floor to Alina Vetrova from the Association of Regional Banks of Russia, where we had this big debates on proportional regulations. So let's now give floor to the actual banker. Thank you. Getting ready to my today's presentation and speaking yesterday at the microfinance conference, I was thinking, why do we talk too little about regulation and development? We are reluctant to talk about that. Just a sec, sorry for intervening. We have a special department on development. Absolutely, but this department will think about you only and deal with your issues only. And then I remember those 233 KPI and the department on development who will engage in that. So the first step has been made. This morning when I was listening to Elvira's presentation, I was so optimistic because I realized that we have such a strong regulator who does take care about the development of the sector. So your story about tightening the screws has been already finalized. We are over that and we're looking forward to new perspectives. So I'm quite optimistic about what's ahead of us, and that's the topic of my today's presentation. First, why do we need this very proportional regulation? Why do we need measures to limit the share of biggest players in our market? Why do we need to nourish smaller banks and smaller market players? For a long time already, the Russian banking system has a structural imbalance with state-public banks dominating. To my mind, this structural imbalance prevents the sector from developing effectively. It prevents the sector from realizing its potential, unfolding its potential and its importance for the system. So the proportional regulation that has been just implemented, that we just started to embrace, may potentially solve this issue. So it may potentially nourish, beginning from microfinance institutions, then banks from specific and later universal licenses, and then major credit institutions. So we may start in this order, but we need to maximize risk control. If we impose maximum requirements in terms of the risks, then we are safe to achieve that. Banks should take advantage of the direct access to customers, the individual approach to customers. They should tap on these opportunities in banking regulation too. I'd like to say that the dominance of state-participated banking institution is not limited to Russia only. That's the problem relevant to other countries. I started international experience, and even in Germany, that historically has a major part of banks with this or that part of government involvement, is still below 40%, which is not the case in Russia, unfortunately. In Germany, there are constant debates about the necessity to privatize those public institutions again. Another point to mention regarding the competitiveness and competition with major player, I guess it's not the question to be asked to regulator or central bank, but it's a question that we mentioned earlier this morning about violin and the pipe, and namely the access to government resources and programs. Again, the rating could be a benchmark to determine if a bank is stable, is resilient, and if it can access government resources, if a rating can be considered an independent estimate, independent evaluation which proves the reliability of financial institution. Unfortunately, capital is usually used as the criteria for bank stability. So here I think the central bank should intervene and maintain the dialogue with the government and explain that the capital is not the proof of banks' financial stability, and there are other criteria beyond that. Despite the fact that we do have the need in proportional regulation, and it has already been recognized by financial regulator, when we talk about the banks with basic license, unfortunately, those banks have only very slow or very little flexibility in terms of banking regulation. I think we should look into that once again. We should consider what measures could facilitate the development. How can we aim more at the small and medium-sized enterprises and banks, and in particular by stimulating, not regulating them? For example, we could introduce lower equity ratio for loans to small and medium-sized enterprises. As a criteria, we could use MSP bank loan standards or any other standards that could be used to evaluate the bank stability by a regulator. So the last point that I'd like to mention in the context of proportional regulation is the development bank issue. Again, I think that this topic has not been adequately addressed in our country, and this instrument has been underused, hence it does not influence the economic growth and banking sector development. Maybe we can expect a leap of faith in the nearest future, but there are other institutions to develop SMEs, including SME development banks that are currently competing with credit organizations involved in the MSP loan program. Again, maybe not a regulator, but rather the state should focus on the domains that are not in competition to other sectors or areas, but rather contribute to the development of banking sectors and products. Well, that's essentially it, to put it shortly. I'm not gonna elaborate on details. We have come up with a number of proposals. Another thing I would like to mention, and previous speakers have mentioned that as well, and namely, predictability is a critical thing for a banking sector, and there should be a very clearly cut outline or agenda for banking sector development, so that we could understand where the credit institutions should head to, where they should develop, and what sectors of economy they should focus, what novelties will be introduced by a regulator as well as restrictions. We want and we need to make it transparent for 3 to 5 year term, so that banks should develop, should set their strategies and stimulate economic development. Thank you for this exciting suggestions. Just a small remark before we give floor to Alexey. I just want to focus on 3 points that you've made. We do have a strategy for banking sector development. Indeed, it could be improved regarding the new priorities and benchmarks. The only thing that is probably missing there is that we don't want banks to, we don't want to impose any domains to the banks where they should have, where they should issue their loans, like you should go into oil and gas sector, for example. We won't gonna do that. Second, talking about an MSP bank as a or SME bank as a development institution, our SME bank is a partner to SMEs. If you consider its balance, it basically buys out credit bank portfolios and refinances them by issuing guarantees. So it's a partner, not a controlling entity. And here we really look eye to eye with you. And finally, the proportional regulation that we jointly agreed upon and proposed to the banking community. Alexey will probably elaborate on the documents that we will issue shortly. Probably it's far from being perfect, and we do not claim that it is. We'll see how it's gonna work out for the institutions, but I think we should consider more important issues, like, for example, we should discuss if banks with basic license should follow international standards when it comes to accountability reporting. Those are not public companies, and probably it's not that necessary, considering how challenging those standards may be, especially for provisions and other aspects. So I would probably discuss this issue. We should think how to make the job of small and medium-sized banks easier regarding the requirements we impose on them, but not the level of those requirements. Thank you, and here I hand over to Alexey. Good afternoon, dear colleagues, and thank you for the opportunity to think together about the correlation of financial regulation and development. A lot has been said about that, but let's have a top-down look at that. Let's look at the macro level. Every half year I indulge in this very sad exercise. I download the banking reports. I consider the consolidated assets volume, except for some banks. Then I translate that into foreign currencies and compare it with other countries. And that's what I have as per 1st January this year. All the consolidated assets of all our banks accounted to 74% to Citigroup assets and 79% of Deutsche Bank. That's the picture of Russia at the global arena. If we exercise this quantitative comparison. However, recently Russia was among top 10 countries in terms of GDP volume, and even after devaluation is in top 20 countries. So consider the needs of the economy and the capacity of Russian financial system. So clearly there is a kind of imbalance that we will need to address either by evolution or revolution. Because despite all the efforts applied by a regulator, unfortunately, even in mid-term, Russia is unlikely to be a country where the financial market will oust the banking regulation, so banks are and will be the main source of economy of financing. In this regard, this very challenging discussion on the risk concentration evaluation is relevant, where we need to adjust this norms and regulations on the one hand. On the other hand, we are contacted by major lenders who ask to do the same, and we end up with this very infamous N6. But the reason is very simple. We don't have enough equity to finance the current Russian economy, which is currently at the verge of the crisis and hopefully at the growth trajectory.
О соотношении регулирования, да, банковского, пруденциального, в более широком смысле финансового регулирования и потребностей в развитии, всегда хочется обратиться к какой-нибудь умной книжке и почитать, что же там умные люди пишут по этому поводу, чтобы не изобретать велосипед заново, не тратить на это свои силы. Ну и вот открываешь литературу теоретическую, например, да, по теории банка, по теории банковского регулирования, как мы вчера на макроэкономической школе обсуждали со слушателями. И мы убеждаемся, что там нет мотива развития.
And we made sure that there is no development. So the existing notion of the nature of the banking sector cannot be described as a purpose of stimulation of economy. We don't know what needs development. So, as a reminder, I would say that modern theory of financial intermediation says that regulation is needed when the financial services market does not manage to provide the necessary supply, quality-wise and quantity-wise. It's not quite clear how that is related to the development. Unfortunately, the theory does not provide a clear answer to that question. Okay, we forget all those books, we start from the scratch, and we say, let's develop, but tell us what to develop. And that brings us into a more interesting conversation, because there may be several different answers to that. The most popular and the most frequent and the practically important answer is, let us develop funding, loaning to big companies that are the basis of our GDP, or for instance agriculture and fuel industry, or several industries, or regions, or some banking products. So let us create the best conditions for them so that they can raise from the knees and stand firmly. You understand very well that as soon as such proposal is made, and we try to meet the regions, industries and companies halfway, there's a long line immediately of others who say, we are no worse. Provide the same conditions for us. Provide the same benefits for us. I can't say that practice is always more interesting than theory. I can't say that we do not meet them halfway. By way of example, I can provide information about several steps that were made recently. For instance, this is a reduced burden on capital for legal entities and companies in the Crimea. It's clear why we did that. So this is an example of such regulation. And other examples are providing the best conditions, of course without violating our international obligations, in issuing loans to SMEs, loan mortgaging, etc. But that doesn't answer the question why these sectors and segments should be supported first and foremost. Why not others? Then we can provide a different interpretation of the same answer. Let us not directly support some borrowers, regions, industries or products, but indirectly, creating financial intermediaries who would be specializing in financing those priority industries or borrowers. A vivid example of that is setting up a new financial intermediary in the Russian market, and that is a bank with a basic license. None of such banks have been set up yet, but the main purpose of such banks would be to use their competitive advantages, and that is their knowledge of the borrowers who are ready to work with them. Yes, those are small companies, physical persons, and that is an indirect support to SMEs. And possibly there is a third answer to the same question, because why is the second way difficult? Other financial intermediaries will ask us why special conditions are created for certain financial entities. Let us provide the same conditions for everyone so that the competition is fair, and it's difficult to object to that. And logically, the third option is to try to create instruments in the tool available for all kinds of financial intermediaries, big and small, specialized and not, that will bring us to that goal. And that goal is to support the borrowers who are important, and they are important. Well, for instance, why do you need support to agriculture? Because everyone wants to eat, and because our big unpopulated territories may provoke interest with our neighbors. So we need to support certain regions. So there may be a lot of priorities, and they might not be financial priorities. And as an example of such instruments available to all the participants of the market, I can provide a few new solutions. For instance, we decided, in all cases when that is possible, when that doesn't violate international obligations, to take the ratings of Russian credit agencies, although it would be better to wait for 100 years when there is a history of defaults, when we stay with strong companies that we can safely work with. At the same time, we understand that unless we create a certain privileged conditions, probably the rating industry may not be in existence, and the ratings would be known to all of the market. Every bank, every investor can use those ratings for the regulatory purposes, and such ratings already appear when they make sense. In 2012, we recognized the sufficiency of the capital in netting. And that is another example when we did not have a lot of positive or negative practice of using netting, but we recognized it in regulations. And probably quite soon we will streamline the collateral issues and probably will use those regulations that can be used as a tool in transactions. So, speaking logically, we come to the scenario that the Bank of Russia is trying to stick to by supporting those growth points and the products and instruments available to most of the market participants. By the way, when we are asked to stimulate by regulation, stimulate the appearance of what is absent in the... So the banks with a basic license, so far there aren't such banks, but we need to develop a regulation for it that will be clear, a purely engineering problem with a lot of uncertainties, and quite possibly the first attempts will fail and we'll have to adjust those regulations when such banks appear. We are ready to do that, and we do not pretend to be infallible, because life is multifaceted and life will make us correct our regulations if we see that the model that we have drawn is not viable. Nevertheless, we need to differentiate between the financial intermediaries and solve a difficult problem that was unfortunately rarely mentioned today, that the new generation of regulations introduced by Basel wise men and women, Basel III or Basel III Plus, is so difficult and costly that it's difficult to be used by all the market participants in all the countries. So that is about everything I wanted to say. Thank you. Thank you, Alexey. Alexey's speech was very academic, and if you are not against, we will prolong the session for 10 minutes. Well, what you said about the sad exercise that you do every half year, well, I don't know why it is sad. Look at the panel headed by Dmitry today. There were some allusions to the article that is very much discussed about the rabbits and elephants, and your result is that somewhere in the global jungle there are animals that are bigger than our animals and bigger than our banking system. But so far those beasts do not go into the forest where our rabbits live, so to say. So those huge beasts are scared of entering our forest so far. So you grow and we will train you so that even the small beasts play by the same rules as the big beasts. So I think what you are doing is quite optimistic. Now, not to trespass on our time, I will stop and will pass the floor to Sergei Solonin. I wanted to learn very much. Well, we're all talking about fintech at every forum and every conference where I participate. There is a panel dedicated to the fintech, but there are virtually no panels dedicated to its regulation. So while you're still small, we will watch you, but we will not regulate you so far. We will only regulate you as soon as you grow big. Well, we know that fintech uses different business models associated with different risks. So what I want to understand is what regulation does fintech want to get? Thank you for the question. Well, look, from the standpoint of our desires, I will say that we don't want any regulation, just as I thought. We don't want any regulation. Coming back to the issue about the strategies, it's no surprise that there's a lot of discussions and conferences dedicated to fintech. I think it's because we are slowly making a choice in favor of innovation and technologies. And at St. Petersburg Forum, the President was talking about digitalization, and I hope that we've made that choice in favor of innovation, in favor of development. If that is so, a lot of views on regulation should be reviewed. Of course, the strategies are not static, and observing what can be done and what may be done in the new territories, one of which is fintech, is becoming an important aspect of the regulator's activity. I can say from my previous experience that really, on the one hand, the fact that the payment market was not heavily regulated in the past allowed us to create a very competitive market in this country. And I can see what's happening in other countries. Really, in payments, we have very advanced technologies, and we launched a lot of products much earlier than others because this competitive environment was created, and there were a lot of payment systems in that competitive environment. When everything started, there were about 40 different payment systems that learned from one another and quickly accumulated a lot of knowledge and learned about the clients' wants. When that market was regulated, the central bank said that the only player in this market that can create wallets are the banks. Ever since that, I haven't seen a big new payment system in the market. Well, that's good for us because it protects us in some way. But if the strategy is to innovate, certainly those barriers that we set up for ourselves, they reduce competition and they kill the desire to do something new. So, a possibility of creating regulatory sandboxes or some territories where the companies will be allowed to experiment, when you can do something new under the supervision and observation of the regulator and show some new products. In my opinion, that is extremely important. You can look at the experience of India, Singapore, the UK, the US, Hong Kong, and there's a lot of countries that followed that path. And I think that we need to be at a good level in order to reproduce the experience of fintech market development in the area of payment, which was very successful. Sometimes, well, people talk a lot about a new law on cryptocurrencies. We already started discussing that law, and it is my understanding that if that law is passed in the nearest future, it won't be good for the market. We don't yet know some aspects of technologies that have only emerged and that have been developed. And sometimes a purposeful absence of activities by the regulator, especially in creating such laws, may be very positive for the market. And that may provide a possibility for the market to prove a technology and to see the result. So, the part that the regulator plays in all that is extremely important. The regulator may make a focus on innovation or regulate the market in such a way that there will be no innovation at all. I think it's very important to understand that we are under sanctions. We're in a difficult situation difficult for the banking system, a situation that is difficult for the market players. And we need a whiff of air. We need space for that market so that the market develops. I know that there is no time left, so I will finish with that. Thank you very much, but we want a dialogue very much.
Thank you, and I may still take a minute from you just to comment on the issue Sergei raised. I have nothing against a sandbox, but the specificity of fintech in our country is that our largest Russian bank is turning slowly into fintech, and it won't fit in any sandbox. Sorry if that. Well, when I was asked abroad what is the major challenge of a fintech market in Russia, I said that if we spot just one challenge, then the market here is so monopolized that's just impossible for new companies to gain market share without regulator involvement, because we have so many initiatives abroad that were aimed at doing the same, but in Russia we should apply tenfold as much as efforts as they did. Yes, because you consider fintech from your point of view as something small that wants to grow big in a short period of time, but fintech is more than that. It's the use of the same technologies by major market players. I don't want to advertise nobody here, but at the previous panel we had the owner of another high-tech bank, and that bank has a solid market share, and it has been a solid fintech institution. It's a very important part of a financing banking system that will require special regulation, because the digitization of finance is, to put it simple, we can compare it with the Uber. How Uber can lease a car without having it on a balance sheet? Again, the digitization of finance leads to the fact that somebody can credit you without any equity, without liquidity, without any reserves whatsoever. So that institution will sell you a service or money without having that actual money handy. So the original metrics, the original requirements to fintech were aimed at organizations that have equity, liquidity, and provision. All those risks are not of financial or prudential nature. They have technological nature. and many regulators are not ready to embrace those risks currently. That's why we, being a regulator, the Bank of Russia, we put this question on our agenda as a very pending and serious matter. And we're looking forward to having a dialogue with the banking community to develop those standards. Again, thank you. I think it's time for us to wrap up. Hopefully you've had an exciting and fruitful discussion. Thank you.